We have here a very nice set of panelists with two limited partners from two different perspectives. One is a family office, and one is a major French investment bank and banking player. This is Natixis. And Sven Berthold from Vega Support is a family office. I'm going to leave also the three GPs, which are raising funds or have raised funds, comment on their fundraising and on the relationship of LPs and GPs. Starting from left.
Soto from CEFI Madrid. We are a GP working on the mid-cap sector in Spain, doing buyouts. We have just done the first closing at 140 million euros, and the target of the fund is 150. We plan to close the fund in the first quarter of next year, and that's it.
Christoph Hemmele from Finatem in Frankfurt. We are currently raising our second fund in Germany. We returned 1.5 cash time to investors for Finatem 1. We have a first closing 74 million euro currently. We focus on mid-caps in Germany, 25 million sales up to 125, same kind of valuations. And we have a special approach in terms of a mix of private equity people and operational partners being able to add value in companies.
Morning, my name is Simone Cimino from Milano. We just raised a 125 million euro fund. Is our fourth vintage. In the past, IRR for us has been 3 times the money for our investors and more than 70% IRR. We do small buyouts, old economy, and we basically operate from Milano to Venice, down to Bologna, in the northeast region of the country, and we operate with 2 offices in China.
My name is Sven Berthold. I represent a family office called Vega Support. Vega Support is the family office of the Wendland family, who made their fortune in the bakeries industry, sold that company in '99 in a successful private equity transaction to the Camps AG, which is now part of Barilla. As a family office, we like private equity since the entrepreneurs have had quite some success in the field, and so we allocate 20% of our net worth to private equity and invest in approximately 7 funds per year globally.
Jean-Louis Delvaux, I do represent Natixis Private Equity, which is one of the player in France, and we have been operating now for about 15 years. Our segment is definitely the mid-cap segment, where we rank first in France, but we have now expanded in Europe, and we've given our support to the 3 funds which have been presented just now. We manage altogether 2 billion euro, out of which about half is our own money, the bank's money, and the rest is third-party money.
So I'm first going to start with the limited partner perspective, and with your perspective on being a smart LP, managing money intelligently. Natixis has 15 private equity teams, so you surely have comments on what works and what doesn't.
Well, as a matter of fact, what I want to stress is that we definitely visualize ourselves as a cornerstone LP, which differs from the standard LP, if I may say. When we decide to support a team, we basically want to have an in-depth knowledge of the team, and what we have done, as a matter of fact, whenever we supported first-time fund, was to try to live together for some time. That's why in each of the funds which have been described here, we have set a period of time, which was like 2 or 3 years' time, where we made investment direct with the team. In other words, that the team got to know us, and we got to know them very intimately. And that is indeed, for us, the best way to make what I would say what our due diligence. Now, after we have gone through this period of time, then we definitely want to bring some value to the team when the team goes to set the fund, which will be open to investors. And there, obviously, we are not going to act as a standard LP, but we are going to try to focus on what I would call the major things. In our opinion, the major things are when you set a fund, is to bring our own experience that we have developed with other teams, and definitely that relates, for example, to the fiscal and tax structure of the funds. It also relates to, for example, the alchemy, I would say, that takes place when a fund is launched between the people, between the members of the team. Somehow, at a point in time, everything has to be, as I say that, well balanced, and an investor like ourselves can play a role in helping the team to get to this point where everything is well balanced, and therefore the team is really prepared and ripe to go to the market. Now, obviously, we are not providing only money. We are definitely providing more. However, money is key. And as a cornerstone, we have to commit ourselves to a certain percentage of the fund, which usually varies, but is in the magnitude of, let's say, about 20% or so. And this is really what the GP expects from us. Now, this goes, I mean, obviously, such a strategy means that whenever we support a team, we take responsibility vis-à-vis the team as well as the other investors. Now, the responsibility we take vis-à-vis the team is that definitely we are going to give an exclusivity to the team, and we're not in a position of just asset allocation. That is to say, if we support a team in that segment of the market, we are not going to support another team. Now, relating to, I will come back to our role of, being somehow sort of guarantee to the other LPs, but relating to our, I say, common life with the GP, I believe that a cornerstone LP like ourselves definitely can bring more than money, and. I'm sorry?
Does it include deal flow?
Well, what it includes is definitely the team building or the network. In other words, when you have 15 teams like we have in Natixis Private Equity all together in France, in Europe, and now one in Asia, definitely at a point in time, these people, because we are in a people business, and as soon as these managers get to know each other in certain events and certain meetings, socializing meeting, if I would say, there is something which develops, which helps to communicate on some trends of the industry, eventually exchange some experiences. This is, I believe, in the long run, that can prove to be rather valuable. Now, we can also, I think, bring some of the knowledge that we have of what we consider to be the best practices all around in the industry. And this is something which is evolving. And I believe that, when a team has set up a fund, the team is going, after having this period of time which is very demanding of fundraising, the team then will dedicate itself to making deals and having the fund working. Now, by that time, the conditions of the market may change year and by. Our, being in the position that is ours, we can have some kind of an overview which may be useful to to give to the team on an ongoing situation. That is to say, therefore, share some of what we see as being the evolution of the market. And eventually, I believe that can be rather helpful to the teams. Now, obviously, it is true that we are also, on the other hand, not only a cornerstone LP, but for half of the money that we manage, as I said before, we have teams which invest directly. So therefore, the dialogue that we can have with the teams is definitely of, I would say, of another nature than the traditional LP, which will position itself only as an asset allocation provider. Now, I never, when I describe that, I never describe what we should not do, but obviously what we do not do is definitely that we are not going to interfere at any time with the management, because we definitely believe that, I mean, a GP has to work as the market expects. And in no way the cornerstone investors that we are is going to interfere. That would be, I think, counterproductive. Now, I said before that and somehow being a cornerstone LP is some message which is given to the other LPs, because for some reason they will consider that a cornerstone investor is taking some kind of responsibility in the whole thing. Now, our view is that a cornerstone investor should at no point go against the general investors' position regarding the fund. We are not going to act in a way that would be adverse to the general consensus of the other investors. But we believe that somehow we should have ways to make these investors more comfortable in certain situations which can be very, I mean, critical. And I'll just refer to two or three cases. First, if the investment policy of the fund would definitely differ over the time of the fund from what was announced as an investment strategy of the fund. So that's really a problem sometimes. Also, we have to face eventually very rare situations, but still may happen, which are that key man clauses at a point in time do not work. And also, we have also to make sure that over the period of the life of the fund, somehow what is needed as a human resource to make this fund work in a nice way, to make sure that these human resources are met. So, in a sense, 1 minute left. Okay. In a sense, being a cornerstone means taking some responsibility, but in my view, in our view, never at the detriment, I would say, of the other investors' consensus. Sorry? Okay, last word. If we live together, as I've described what a cornerstone is, somehow maybe at a point in time we have to give birth to the new generation of fund, the successor fund that will come out of this joint, this sharing of experience, I would say. And there, obviously, a good or a great LP, like a cornerstone LP, should be in a position to be with the GP when the GP looks for money again at the successor fund, and not himself alone, but eventually, because of its stature and its reputation, be able to bring other investors along. Therefore, then the GP will be happy.
Thank you very much. Sven, your perspective from a different perspective, family office, you don't have position as cornerstone LPs.
No, we don't.
Okay. How does it work out when you're working with a cornerstone LP and you don't share the same point of view?
I'm not sure that we've had that kind of situation, really. I think we normally would tend to avoid having such funds, actually, because our fear would be that the cornerstone investors might have too much say. Although I know there are preventions in the LP agreement not to have that happen, but there is definitely some weight from the cornerstone investor.
Okay, and back to your guidelines about being a good LP as a family office.
Right, so since I represent a family office, I'm going to sort of try and start off with giving some sort of insight in how we think you can go from good to great as an investor, and then we'll have a look at the do and don'ts for LPs and GPs respectively. So maybe let's just dive into the first slide. And I'm not going to talk about the most common sort of points about how you have your investment strategy set up, but probably some points off the track of those lines. So first of all, we have found it to be quite useful and helpful to have asset allocation defined and the strategy laid out in advance, and then probably stick to that rather than venturing out into very interesting things which you find along the way, because there are quite a few interesting things out there, no doubt, but instead of amassing sort of a portfolio of exciting funds, you want to make sure you're balanced on that and you want to have yourself covered there. So, but I would not state that asset allocation and the strategy you've set up is overriding the manager selection. If you can't find the fund you really like or you can't get in, I would say you skip it rather than do it. Then also, I think we believe that you should identify the risks in a fund and then make sure you can live with these. Again, if you want to make above average returns, whatever that is, you have to take some risks too. But you don't want to end up in a position where you took risks you weren't aware of, but you could have just because you were so excited about it. So, I mean, you want to make an informed decision there. And we think by trying to do that, we'll live in a culture where, you know, taking bets and probably losses is acceptable, but you also see it as a continuous learning process along the way. Then I've got the point, don't invest thereafter, hope for the best. That really refers to staying close to the GP as the ride goes on after the investment.
Everyday reporting?
No, not everyday reporting, but probably we come around once a half a year or once a quarter, get some updates there. I think that's quite critical. We try to be value add. Being entrepreneurs, we have some insight into some industries, so we're very happy to help out with the GPs there. Obviously, on the venture capital side, I don't think we can add much. And then finally, use your network. Of course, you should do due diligence and negotiations and stuff on your own, but you shouldn't underestimate the reach of your network and the insights you could gain from that. And I would strongly support using it. Okay, so let's go to the LP do's and don'ts. Since I'm an LP, I'm not going to comment really on those. I think the GPs can do better on those. What I would say is that, of course, if I were a GP, I would wish to have an investor, you know, who's friendly, happy, and not too critical, I guess, with the questions I ask over time, who's got deep pockets and willing to reinvest all along the way, and who is value add. I think that would be sort of my dream LP. Although I'd like to say that we've noticed some sort of dislike for critical questions as fundraising has progressed into later stages. The later you come, the more dislike on the GP side for those questions, and it can actually lead to you being excluded from the fund. So I would recommend either not doing it, but as you are going to do it early on in the process, or just before you take the GP to a nice dinner, right? LP don'ts, I would say you should be frank and open via the GP. Tell him where you stand regarding his investment opportunity, where you see the strengths and weaknesses, and give some explanation of why you maybe not chose to invest along with him. I think that's just fair. And you shouldn't come with last-minute LP agreement changes. That doesn't really help either. And you shouldn't, of course, interfere in the daily management. I think that's not what we're seeking to do. Okay. More importantly, on the GP do's and don'ts, I think a GP do is to keep your promises. That refers to strategy or claiming, for example, you are a non-auction player, but then we see you at every auction in the market. I think that would be a negative for sure. And also, if you are promised an allocation in the fund, then we would like to see that allocation come through in the end after signing the documents. Also, I think investors will highly appreciate transparency regarding your operations, your deal flow, progress with the portfolio. I think the more you communicate there, the better it is overall. Investors just like the feeling to know whether they use all this information or not. Might be, another question, but I think it is appreciated on our side. Also, you would make our lives much easier if you would show us how you add value along the way. It's just, showing the EBITDA figures, revenues, debt pay down, or whatever on the venture side, maybe how your companies have made progress over time. It's just much easier to reassess an investment when the time comes. And finally, I would say that equal treatment of LPs is a point we would like to see. The only exception I would make is in the case maybe of a cornerstone investor being on board. I would say that some reduced carry or management fees there is acceptable. But generally speaking, I think LPs deserve to be treated equally. Okay, that's about it.
The don'ts?
Oh, the don'ts. Yeah, we've seen funds come in and during the fundraising process sort of guarantee me returns in advance. I don't take those, and I don't think many of those funds actually managed to raise a fund. Yeah, bragging, just telling us how good you were and are, and you are the best. Well, if we look in the figures, sometimes you're not. So I think that's something you should watch out for. And finally, arrogance is another point. Yeah, it happens at times that you do bump into such people, and I don't think there's an actual need for it.
What kind of returns do you look at? Not guaranteed returns, but that seems to be to you in the market today for venture capital, since you have an allocation in venture capital, and for LBOs.
Well, for venture capital, it's tough to say at this point in time, but generally you would expect a higher return than on buyouts. And on buyouts, I think you would be pretty happy. I don't know, it's tough to say, give the returns.
20%?
Yeah, above that, above 20% net, I would say. So I don't think we've gone down with our return expectations all along the way.
Okay, thank you very much. Now we're going to go on the GP side and across different countries to see how the private equity market stands, how the fundraising process works, and how the do's and don'ts are felt by the GPs. First, Germany.
Thank you. Well, let's start with the market, I think, very quickly because of time like we have. The most important thing today in Germany is we have still a consolidation going on. I mean, everybody knows about the Neue Markt. I think this is something everybody heard here in the market. The consequence of the Neue Markt still today is that we have roughly 50% players less than in the past and roughly 50% less money invested than in the past. The second thing is 2000 is also a very important year in Germany because you started to have a lot of changes in tax regulations. I think before 2000, if you look on GPs in Germany, you will find a lot of people with a good track record before 2000 because of Neue Markt partially and because of leverage effects you were able to have on the market. We were talking of 70% debt sometimes. It's coming back slowly, but this disappeared because you don't have any more the tax gimmicks. So you have a general drop in returns starting in 2000. Just to give you an idea, on realized IRR before 2000, concerning our partners, we were roughly at 38%, and now we have 28% in our case. The second thing is that money currently is a pan-European question in Germany. The money invested in Germany is going into pan-Europeans, and the money invested by the pan-European funds comes to Germany partly. So roughly speaking, you have 60% of allocated money today is linked to pan-Europeans in Germany, and you have roughly 90% of capital raised in 2003, and we're slightly in the same figures for 2004 in the 9 first months. Last thing is the German market is, I would say, only a buyout market. You're talking about 100 buyouts every year, of which 5 buyouts do approximately 80% of total considerations. So that's the market in Germany. So you have big players on the big buyouts. You have a few non-captive independents on the small mid-caps between 25 and 125 million valuation. That's where we are. And then you have a lot of state-owned, state-linked, private-owned, non-independent funds working on a level below 20-25 million sales. We have a trend. We have currently a trend that more money comes to Germany and more money is again invested. But if you look on the expectation people have, they still concentrate on big buyouts and they hope on going on of globalization, consolidation on big groups with potential then for buyouts. I would say that this is going to be a challenge for the next 2 to 3 years. We have a lot of liquidity in the market now on the top end of pan-European players, and when we look on the multiples paid for some company, I would say the only way to get that back is because liquidity at banking level is increasing also, and recaps are doing a lot in favor of pan-European buyout funds.
There's been, I think, $3 to $4 billion deal this year.
Yes, that's a typical situation in Germany. You have with 3-4 buyouts in Germany, you have 80% of money invested in the year. So that's the market everybody's focusing on. Local conditions for fundraising, well, first thing is 80% of the money comes from abroad. So being a local mid-cap fund in Germany, you have to go abroad, you have to speak with people, explain mid-market market in Germany. There are a few investors in Germany, and they are quite difficult because they had some bad experience in the past, especially on the liquidity side. That's the second thing. If you look on German investors, being domestic investing, meaning that they still invest in Germany, they don't go into pan-Europeans and cover now pan-Europeans buyouts. You'll find banks, you'll find insurances. In fact, insurances maybe 10 today still investing in private equity in Germany. They have restructuring going on, they have liquidity needs. They prefer to go into mezzanine products in secondaries because of liquidity. And the banks, well, it's still an interesting fact to speak with banks, with local German banks, because they don't agree on the way private equity should be, being independent business done without a bank on the local side. The third thing is life jackets. I call them life jackets because currently that's people saving our fundraising in Germany. It's private individuals and public co-investments. Private individuals being family offices, or let's say not sophisticated family offices, still believing in the mid-caps in Germany, also in the chances of globalization for the mid-caps in Germany. And public co-investments, there is I think a very well-known public co-investment in Germany, which is the KfW, Kredit für Wiederanstalt. You'll find them, I would say, in every second and the third fund in Germany. Increasing importance of fund of fund. That's a very important thing, that fund of funds in Germany start to invest in an international way. They get more mature, more professional, come back and look now on local teams, especially on emerging brands. That's the way they call us now, because we have a second fund, return money from the first fund. So we're not anymore a first fund, we are emerging brand, which is nice to hear. And they give us a chance which would not be given by, for example, by insurance companies, which focus on more mature funds.
Just a question. People know about this. Probably one of the most famous world, Mittelstand. The medium-sized company in Germany is rich in terms of technical leaders in certain fields, but it doesn't want to sell to private equity. Is it about to change?
Well, I think it's changing since 10 years, but it's still a very difficult thing. In fact, if you look on our track record, we had about 1 to 2 buyouts every year since 10 years now. And the difficult thing is that you're buying a company which is managed by owners. So you have no transparency. You have, if you buy the company, you have to do a few restructurings before being able to standardize it to a certain level to sell the company to pan-Europeans, for example. So we see a lot of deals, and we do deals, But if you compare this type of deals to paper deals, or let's say to more mature deals you would see in France, Netherlands, England, etc., you have to be local. You have to be able to take over management if necessary for 6 months to establish EDP, just to be able to offer covenants for banks, what you normally can't do if you buy a classical Mittelstand with 40, 30 million sales, nice products, good expansion plans, but, well, I would say just a stomach thinking in terms of financials. Okay, you have to have time to change that.
Okay. Do's and don'ts.
Do's and don'ts. Well, I try to focus on let's say, the most important. I think the others are basics you probably know about. But I would say on the do's, the first thing is being a local fund in Germany where domestic investors are not mature also in terms of agreeing on an independent management of a fund. It's very important to have a cornerstone investor being able to set up standards. And that was, I would say, our fundraising would have failed completely if we wouldn't have the help of NPE in this time. That's a very important fact. If you take a cornerstone investor being a local bank, well, you end up to be I would say captive, and it's quite difficult. Then you're still in conflict of interest in Germany. The second thing is being opinion leaders and also having contact and networks. Currently, our added value in the portfolio comes from expansions in outside countries. And you need contacts, you need network. And believe me, it's quite difficult to finance a German company buying a French company with French banks. It's still very difficult to find solution on a mid-cap level. If you go over 100 million sales, it's different. On don't, same comment is overload with major domestic investors, because currently in Germany they are not as mature as you will find in France, England, and other countries. So you have to have investors giving you the ability to think in pure equity. In do's and don'ts from the fund management, I think liquidity is a very important issue in Germany. Our major competition comes from mezzanine and secondaries, as I told you before, because insurance companies can't accept to go in a 6-year fund or more, 8 years, having no returns before 3, 4, 5 years. So that's a very important issue. And it's worse if you talk to individuals. They want to have a recurrent income every year. I think most important is the ability to say no if you're already invested. Follow-up investment is, I think, one of the most dedicated decisions a fund manager is able to take, is if to know where you should stop when you're involved in a company, where you should stop and say, it's a mess, stop it. Long-term progress of your team, everybody talks about it, but it's a very important issue. And I think the rest is well known, and last point is a general point everybody knows about.
Now a very different market that is very active today, and a lot of LPs are focusing on it, Spain.
Yes, it's true that actually Spain is moving. It has been moving. The economy has been moving the last years, the last 8 years. I think the market for private equity is moving in the high range. I mean, there are a lot of players, and is an increasing number of players that goes to transactions that are above 30 million euros. You have the local players, and you have other players that are coming from international private equity players. There are a number of, or a limited number of mid-cap players. What we call mid-cap is in between 10 to 30 million or 10 to 25 million euros in equity investment. And more or less the same that my colleague Christophe said before, there are a large number of smaller players, in many cases sponsored by local governments, doing smaller transactions in the market. But it's true that the number of deals are increasing, and the number of large deals are increasing as well. Recently, 2 weeks ago, it was announced one that could be one of the largest transactions in Europe is an 11 billion euros offer for the second telecom operator in Spain, done by CVC, Blackstone, and five large international private equity players. the number of potential investors in Spain is still limited. There is, we lack still of culture in terms of sophisticated investors investing in private equity in Spain. We, in the fundraising that we did, we are undergoing now. We have been able to have two large investors into our fund. Actually, we have the largest pension fund in Spain, and we have the largest or the second largest savings bank in Spain to invest. But there are still some regulations that should be modified and should be worked on by the regulators in order to allow a larger number of potential investors to go into private equity. As I said before, we have already done the first closing at 140, and we plan to do last closing by the end of the first quarter of 2005. The target of the fund is 150 million euros. What we have found in our fundraising, and the questions and the worries, in order to be successful in doing a right fundraising, track record, that's the first thing. If you are not able to show to investors that you have certain exits with a profitability and a portfolio of companies that are still in the portfolio that can or have potential profits in the future, I think that in the present environment of fundraising, it's very difficult to do a fundraising. It's important to have a well-balanced team with different capacities in the team. In terms of finance, in terms of operational expertise, in terms of being close to management or managerial expertise as well. We think that we have that in our team. The fundraising is a very disciplined process. You have to be ready to answer the questions, to have the information ready for the investors, and ready to answer, and at the pace that the investors need the information and everything. Mistakes or things that we shouldn't do, I think, in fundraising is to rush in the process of launching the fund, meaning that you have to have all the information ready when you start launching the fund. You have to at least have a big chunk of the fund invested already, and a large or sizable amount of money returned to your investors in the previous fund. The lack of transparency is something that investors are not willing to allow anymore, as my colleague Vega said before. And to finish with the do's and don'ts in the fund management, it's important in the fund and the sponsor fund like ours to leverage on the investors' experience in different aspects. Their experiences in the markets, in the companies, to benefit from potential cross-border M&A. There are things that we have to profit from our investors. Clearly, we have to not only when we finish the fundraising as everything is done. We have to continue in the years after to give the right information and the proper information to our investors, and to devote the resources to those matters.
And last country to be covered, which is also a hot play, and now we're turning to an experienced GP, fourth fund in the process. Can you comment on your fundraising?
Well, as we mentioned before, we raised this year this 125 million fund in an environment that is growing for private equity. Italy today is number 3 in Europe, after Germany and France and Germany. Italian-based funds legally are becoming more frequent compared to UK or Luxembourg limited partnership, and most Italian medium-sized funds has excellent raising this year. So not only Cape, but funds like Investitori Associati or BC Partner or other people raise funds in the country with great success. So there is a positive trend for the country, due also to a positive trend in legislation, taxation, and corporate governance transparency. Our model was peculiar. We have today more than 100 individual investors that gave to the family 30 million euro. A cornerstone important sponsor like Natixis that was able to deliver 30 million euros actually was committed to more, but we have to reduce the commitment in order to have people coming in the fund. We had more money coming than the money expected, and we are able also to manage, honestly speaking. And as the rest, we raised money. So 50% was coming basically by more than 100 individual investors, and not Texas, 50% were coming from Switzerland 20%, Italy 8%, Luxembourg 8%, France 7%, Belgium 4%, Germany 2%, UK 2%. So it was almost European. The institutions investing in the funds were funds of funds for 40%, banks 4%, insurance companies 7%. What to do, what not to do? Of course, nobody knows before. Everybody think to know afterwards, but then the world changes. You needed to have a decent IRR. We start raising the fund with 3 times cash multiple and 71% IRR. You need to have a distinctive strategy, and we think we have a distinctive strategy in terms of investment. We invest only majorities, only medium-sized companies, only family-owned in certain areas of the country. And in fundraising, we selected a fundraiser agency with Italian expertise. The worst mistake you could make is having a fundraising agency with non-Italian or non-French or non-Spanish people in the team to raise funds in that country. They cannot tell your story around. So having insider in the investor base, not having insider in the country where the money should be invested. So according to me, the worst mistake is having an agency, a fundraiser who is not familiar with the country where the money should be invested in. Not to do what the don'ts in fundraising, the average seniority of the pool in terms of being together. I see too much people trying to get together before fundraising. This is a mistake. And also we pay that because we also assemble part of the team too early, too late compared to the fundraising. This did not help. A lot of people refused to invest in our fund because some of my colleagues were too young in the team. So this is a mistake I will not make anymore. And trying to avoid to work too much on deal making during the fundraising. Fundraising is the priority, and the rest comes after. And also doing a lot of visits around Europe. We sent out 90 PPMs. We did 50 visits. At the end, we had only 12 institutional investors coming in. This is a ratio that appears to some coming GPs as tough, but this is what you should do if you want to raise real money from real investors. What to do in fund management? Hopefully to do the right things to have a return. Investor will never love you if you don't give a return. For the rest, they will forget about you. Especially if the investors are managed by not partners, but employees, you cannot expect loyalty. They just will count you on returns. The rest is bullshit. And according to us, niche differentiation should be decreased in our portfolio. We are investing this year 25% of the money we already raised. So we invest 30 million euro out of 125. This is a lot of effort. So we are making 7 investments in the first 11 months. But we are trying to concentrate in 2 or 3 industry niches to avoid diversification of management and due diligence competence in the team. Trying to reduce the effective investment period to 3 years instead of 5, because it's not important how big is the fund. It's important how fast you invest it, because investors don't like you sleeping on the money and management fees. And try to have liquidity. We plan every year minimum 1 divestiture. Otherwise, people will hate you. people ask you every month or every quarter when you are calling the money, when you are sending call notice, well ahead. So regardless of the rules, everybody, also the largest funds of funds, ask you before when you are calling the money, the next quarter, the next 6 months, because also they have a liquidity problem and a cash management problem. What not to do in fund management? Raising is not the end of the job. It's the beginning of the headache, because then you have to invest. And club deals, according to me and my team, are the worst way you could play in the market, because you risk to become a commodity and people don't need to invest you the next time if you are full of co-investment. You should demonstrate you have your deals. And we are, as you mentioned before, we opened 2 offices in China, one in Shanghai, one in Canton. The offices in China are devoted to create startup manufacturing companies for the portfolio companies we have already invested in. And we have 1 Italian manager and 3 Chinese native people there. And China for us is a threat, is an opportunity. Every due diligence we do for Italian companies, there must be a China SWOT analysis before. And investors is something that you have to take care of. We did an informal 6-month meeting. After 4 months of the first closing, at the second closing, we already invited investors coming in. We showed them we have a mistake in portfolio. The first investment is not performing well. We show them we are doing other investments. So very open and very transparent, because the more you hide, the more they will hate you.
Thank you very much.